Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Tal Cohen. He's the head of North American Equities at Nasdaq, and we're going to focus on pairing and protecting like-minded investors. Tal, thank you very much for being back with us at MarketSite. And there's a market trend right now, the proliferation of speed bump-based markets. And why are they gaining traction, and who's the target market?
Sure. So, as you noted, there's been a proliferation of systematic delay solutions in the marketplace. Exchanges have come out with them, broker-dealers have come out with them, and that's a recognition of a trend that's taken place over the last 2-3 years. And it started with the buy side, and it's moved over to the broker-dealers, where they're trying to implement trading strategies that take advantage of non-displayed orders that reduce market impact. And so there's a recognition that the market needs to go that way. There's been a gap in the market trying to serve those orders and those customers. And I think that's what you've seen over the last 2-3 years within the brokerage community as well as the exchange community.
Now tell us about Nasdaq's Midpoint extended life orders, what we called M-ELO. What is that designed to do?
Sure. So what M-ELO is, it's a non-displayed order, as you noted, that executes at the midpoint. And interestingly, we've incorporated a half-second delay before that order is eligible. And so the reason we've done that is we wanted to pair up like-minded investors in an environment that provides them with protection and certainty around the trading experience for those orders.
Now, does that also help promote long-termism?
It does, and it does so in a few ways. One, it's a recognition that a one-size-fits-all market model doesn't serve all orders. And the second one is it de-emphasizes speed or immediacy in favor of a longer trading horizon for a particular order or trading strategy. So it's a recognition that not all orders need immediacy or speed. There are orders that require an environment that looks after the market impact of that order.
Well, we saw a lot of volatility come back to the markets in the beginning of February. How does M-ELO protect investors when you see that kind of market movement?
So it does so in a few ways. One is it dissuades really market-moving orders or time-sensitive orders from using M-ELO because of the half-second waiting period that we've implemented. But interestingly, that half-second time period, which is a holding period, you can also use that to cancel your orders at any point. So we don't hold up your ability to manage risk while still dissuading orders that would otherwise move the market or are time sensitive from participating within M-ELO.
All right, and to wrap up, how is M-ELO differentiated from other products that are available?
It's done so in a few ways. One is we haven't launched a fourth exchange to implement M-ELO, so you can leverage your existing connectivity, lowering your cost, and we implemented it on our flagship market, Nasdaq Classic. Secondly, is we provide the level of protection you would see with other solutions, but didn't mitigate or compromise your ability to manage risk. And that's what I just went through in terms of being able to cancel without delay, even though we have that holding period. And third, it's quite simple to understand and quite simple to incorporate into existing workflows.
All right, well, thank you very much for joining us at MarketSite. And traders, thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.